In this video, we will see how to identify the assumption or principle that has been violated. The four accounting assumptions form the basis for recording transactions and preparing financial statements. First, the economic entity assumption states that every economic entity can be separately identified and accounted for. Next, under the going concern assumption, it is assumed that a business will remain in operation for the foreseeable future. The monetary unit assumption requires that only those things that can be expressed in money are included in the accounting records. The periodicity assumption states that the life of a business can be divided into artificial time periods and that useful reports covering those periods can be prepared for the business. Let us now look at the four basic principles of accounting. GAAP generally uses one of two measurement principles, the historic cost principle or the fair value principle. Selection of which principle to follow generally relates to trade-offs between relevance and faithful representation. The revenue recognition principle dictates that companies recognize revenue when a performance obligation has been satisfied. Similar to the revenue recognition principle, the expense recognition principle dictates that companies recognize expenses in the period when the company makes efforts to generate those revenues. The last principle is the full disclosure principle. The full disclosure principle requires that companies disclose all circumstances and events that would make a difference to financial statement users. The one major constraint that limits financial reporting is the cost constraint of providing financial information. Companies must weigh the costs of providing the information against its benefit to financial statement users. Let us now look at an illustration to see how to identify the assumption or principle that has been violated. Here, for each situation provided, we are required to list the assumption, principle, or constraint that has been violated, if any. In the first situation, Calvin Company recognizes revenue at the end of the production cycle, but before sale. The price of the product, as well as the amount that can be sold, is not certain. This is a violation of the revenue recognition principle. According to the revenue recognition principle, companies should recognize revenue in the accounting period in which the performance obligation is satisfied. Here, since the company is yet to make the sale, it should not recognize any revenue. In the next situation, Jade Company is said to be in its 5th year of operation and has yet to issue the financial statements. This violates the periodicity assumption, which states that the life of a business can be divided into artificial time periods and that useful reports covering those periods can be prepared for the business. Dunstan Corporation is carrying inventory at its original cost of $100,000. Inventory has a fair value of $110,000. The company has correctly followed the historical cost principle, which requires that companies account for and report all transactions on the basis of acquisition price. Thus, no violation has occurred in this case. Dandelion Corporation reports only current assets and current liabilities on its balance sheet. Equipment and bonds payable are reported as current assets and current liabilities, respectively. Liquidation of the company is unlikely. This is a violation of the going concern assumption, which states that the business will remain in operation for the foreseeable future. Thus, the company should classify asset and liabilities as both current and non-current according to their nature. Baskin Company has inventory on hand that costs $400,000. It reports inventory on its balance sheet at its current fair value of $425,000. Recall that the historical cost principle requires that companies account for and report all transactions on the basis of acquisition price. Hence, this is a violation of the historical cost principle. The president of Yellowstone Company, Melanie Hall, bought a computer for her personal use. She paid for the computer by using company funds and debited the computer's account. The economic entity assumption states that each entity can be separately identified and accounted for. This means a company must keep its activities separate and distinct from its owners and any other business unit. Thus, this is a violation of the economic entity assumption.